Okay, so let me ask you something. What if I told you every single business in the world, whether it's a billion-dollar company or your neighbor's cookie stall, runs on one simple formula? And that is assets equal liabilities plus equity. Sounds boring, but not really. Because once you get this, you'll see how every dollar in a business is tracked, where it goes, and who really owns it. This isn't just math. You can say it's a language of money. So welcome back to our accounting series for beginners. In this video, we are going to break down the accounting equation in a way that actually makes sense, like real world bulb moment sense. Let's get into it. All right, so here it is. Assets actually equal liabilities plus the equity. Think of it like this. Everything a business owns, its assets, is either borrowed from others, liabilities, or invested by the owners, equity. Now, let's first suppose you want to start up a business, and that business wants you to put in about $1,000 of investment initially. Now, this investment will be known as your equity or your business's equity. Now, this $1,000 can either come up from whatever savings you might have put in, so that can be approximately $800, and you got short on $200. So, what you do is you go up to someone or to the bank and ask them to give you some loan or some sort of money. Whatever that amount they give you will be known as the liability which you owe to them. But in the end of the day, whenever you're adding these two things in, you're getting an investment out of it. So now that investment is going into the business and increasing the asset of the business. So every transaction is business boils down to this formula. You buy a laptop for your business, that's an asset. Use a credit card to buy it, that's a liability. Put in your own cash, that's the equity. So everything is actually just revolving around the basic formula, which is adding your liabilities and the equity, which is going to give you the asset in your business that you're going to own by the end of the day. Now, imagine a giant balance scale, all right? A really, really giant one. So let's say this goes in your giant balance scale in here. On one side, you have got all of the assets, and on the other side, you have got all of your liabilities plus the equity. Now, again, just coming back to the same equation back and forth, but it's just for you to have a better explanation in your head so that whenever you move forward with accounting, you have got a good sense of it. Now, this scale, it must always stay balanced. If it tips even a little, something's off. And accountants, they don't like that off, I'd say. So let's say you just bring in some thing and the scale goes in a bad direction. The assets might go down, the liabilities and equity go up. Now things aren't balancing, and things don't balance in the other way as well. When your assets go up and your liabilities and equity aren't really balancing out. Now let's come back to some real life examples. Let's say you start your own online business. You put in $10,000 of your savings into the business. So I'd say your cash, now cash again is a type of asset. So your cash or asset is equaling to a $10,000. Now this is the full amount which you put into the business. So you aren't really asking anyone to give you any sort of loan. So you owe nothing to anyone yet. So your liabilities in that case come out to be a $0. Now let's just like put in to the same equation which we have discussed several times up until now. We can now say that your assets is equal to 10,000 plus the liability that was $0. Now over here, can you see that your assets are coming out to be $10,000 and everything seems to get balanced out by the end of the day. Now, if the equation is balanced, you're the luckiest guy on this earth. Everything's balanced, everything's clean, and everything seems perfect up until now. But now let's move forward and consider you take a 5,000 small loan. Now, a small loan will be counted as a liability, but again, it would add up to the assets. So now your cash is going to be a $15,000. You have got some amount that you owe to the bank, so that's going to be your liability of a 5,000. And then you have got your own investment that remains the same. Your investment would be the equity. Now, if you're not familiar with these terms, I'd advise you to go to the playlist, and you can always like refer to the first video in which I've explained all of the basic terms which I'll be using through and through in this series, just for you to have a clear cut understanding of it. So coming back to this, your equity remains the same as a 10,000. Now let's see if everything balances out. Now putting everything back into the same equation which we have been using, we can say that assets for us are now equal to the liability of 5,000 which we got from the bank, plus the equity which you have put in your investment from your savings at 10,000. All of this should total up to our cash that was showing up to be a 15,000 in here. So I can say that this is going to be a 15,000 when added up, and then my assets again are 15,000. Is still balanced? If it is balanced, so I'd say again, everything looks clean, perfect, and ready to go. Now, here's why this matters. If you want to make sense of financial statements, let's say you want to track business performance or even just manage your side hustle like a pro, you need to understand where money is coming from and where is it going. Now, this equation helps you answer one question, one little question, that do I really own this or do I owe someone for it? So you're just keeping a track of how much you owe and how much you own. Now, these are two different things. Now, let's just define these three basic pillars which we have been talking about. First of all, a quick revision. Assets is whatever you own in a business or personally as well, what you own. This can be a car, your inventory, your laptop, your cash, anything. And then comes in your liabilities. Liabilities are anything that you owe. Now, you can owe some loans, you can owe some unpaid bills, any debt which you are into, whatever money you need to give back to someone. And then comes in the last one, which is your equity. Equity is what's yours after paying off debt, what's left actually for you to take back home. And the formula always keeps them in check, because in the end of the day, accounting is all about balancing your things out, balancing the money out. And if you want to see how much balance your business is going, if you want to keep a track how much you're owing and how much you own, how much profit are you taking back home, all of it sums up to this basic equation, the heart of accounting, that assets will always be equal to your liabilities plus the equity. Even if your liabilities are zero, you got to put it there. So next time someone says the books don't balance, this is, it all comes back to this mighty little formula, that assets will always be equal to your liabilities plus equity. So in the next video, we'll watch this formula come alive through real business transactions, so you can literally see money move and the equation react to it. If you're liking the series so far, give it a like, hit subscribe, and let's keep this accounting journey rolling. Catch you in the next one.